Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are talking about, see what news is out there. Obviously, I'll interject my financial opinions, and we're going to dive right into it to see what's going on. So again, if you want to follow me on here, it's at finding_finance. And if you want to join our community, it's finding-value.com. You can use the word discount in the coupon code, and you can see how I'm playing the commodity bull market. So we do have the Fed coming up next week. I think it's June 14th or 15th. Fed will pause next week. Gold will rip shorts head off. But I just wanted to remind everyone that we do have a Fed meeting coming up, and there is the possibility that they could pause. What would that do to the markets? I do think that some things could rip it. It very much is possible. And that is one thing that could happen. Again, I don't really play these types of moves. I play the valuations and then I just sit and hold. But that is a possibility of what's coming over the next week or two. It says, with oil demand rising and OPEC Plus cutting production, the oil market is at an important inflection point. Speculators remain perpetually bearish on the prospects of a recession on the horizon. But this is now an asymmetric scenario. He's probably talking about going long. That's what he was talking about, where less downside risk, more upside potential. And I agree with him. Nick says, after stabilizing in April, U.S. bank deposits growth ticked up through May at small and large institutions alike. So we are seeing a small uptick in deposits that we haven't seen in a while. It's been going down for a good while, but this is deposits excluding certificates of deposit exceeding 100 grand, changed since January. I believe this one is just deposits in general. Scrolling down, keeping a close eye on the crude oil price chart. So I've talked about this before. I've talked about it a lot on the website and the question and answers and stuff like that. This is the money supply's 10-year rate of change. We can see that it's been coming down here. We can also see that we peaked out in 1985 or 6 or so. It's come all the way down, and then we've been crawling back up. Could this be a breakout here, a retest, and then we launch back up to the upside? Potentially. Money supply also, you have to keep in mind that during this time frame here, we had a large decline in money velocity. Money velocity has recently kicked up quite a bit. So money velocity is offsetting this decline in M2 money supply, and it's probably what looks like the gold chart. So that money supply versus the velocity, they offset each other. Money velocity, if you were wondering what it is, it's money going through the system, creating more transactions, increasing gross domestic product, given how much money is in the system. So it's basically the flow of money through the system that we're measuring and the number of transactions or the transaction total value that it created. That's really what it is. Warren says, so someone asked, what is your opinion, thoughts on OPEC plus cuts? We need to hear from you. And he says, it's Saudis versus speculators. The market has seen this movie before and will not overreact on the announcements. Big draws will get the market's attention, and the Saudi Arabia must be confident they are coming, the big draws. So they're going to cut the market. They're going to have big inventory draws, and that's going to be in response to the speculators. I saw this guy. He said, how to find your financial independence number. It says, add up your monthly expenses, multiply by 12 to get yearly expenses, multiply by 25. Once you reach this number invested, you can retire based on the 4% rule. 40,000 times 25 equals $1 million, financial independence number. So he's using monthly expenses. And the thing that gets kind of My monthly expenses go up and down based off what my kids do. Right now, one of my kids is going through, she's in the competitive cheer, and that's not cheap, but that is something that she's doing. And I'm sure my other kids will do stuff coming up. So my monthly expenses uh, are probably going to be expensive with having kids and all that. So I think I would be comfortable around the 60 to 80,000 mark myself. I'd like to put some sort of safety factor in there. So I would definitely do the 120 to 150. It's what I'd like to do, just in case, if your kids get older, they start eating more food, you get inflation, you get all this stuff. So I probably need $3 to $4 million, is my guess, uh, if there's this 4% rule. But that's me with kids and a larger family, and only me working. I'm not up to that level yet, but I could be very quickly if this commodity bull market starts to take off. I'll just say that. Peter says the oil market will be deeply undersupplied in 5 to 6 weeks as prior May 1st OPEC cuts hits EAI data and SPR ends. It's easy to claim weak demand when inventories are flat, but this will be impossible in July, August, September. WH will likely need to tap the White House will likely need to tap strategic petroleum reserves again by fall as prices skyrocket. So that's his opinion. I'm in the same camp. I hope we get a pullback in some of these oil companies over the next week or two. I'll probably add a little bit in if we do get that pullback. And my opinion is that oil prices will be higher in the future. I don't think increasing interest rates is going to do anything with the demographic. It can slow it down, but I don't think it will stop it. And we should definitely see strong demand going forward worldwide. So let's watch and see what happens. Mike says, is shadow demand, this is talking about real estate here, is shadow demand what's supporting the real estate market? I'm beginning to wonder if what we're seeing is home buyers waiting for an opportunity of new supply or any price change ready to pounce. So he has a little thread here. He says available inventory of unsold single-family homes only ticked up by 0.7% this week to 436,000. There's just 16% more inventory now than last year. We started 2023 with 70% more on the market. Demand steps in to absorb any new supply. So we are struggling to build inventories. That is not what happens in a housing crash. Housing crash, what you see is this thing starts to beeline to the upside. We're still below very low levels. Even 1 million is a very low level. And we're here at 436,000, only up 0.7%. So, guys, we are at still a very low level. There are now 402 single-family homes in contract, just 14% fewer than last year at this time. If you're skeptical about homebuyer demand, note that we're almost back to the crazy pandemic frenzy condition of having more in contract than available. So this is last year's inventory was rising rapidly. This is more under contract than available, and we're almost eclipsing that like this back here. TBF, the rate of new contracts fell this week. It's the holiday, so it hasn't rebounded from the 7% mortgage spike from 10 days ago. I expect a normal seasonal jump in sales this coming week. Late Q3, unless the bottom drops out, we should surpass last year's sales rates. There we go with new pending sales per week. The price of those homes in contract ticked down just a touch this week to 384,000. It's the seasonal peak here too. So by July, we'll see if this season is less abrupt than last. I suspect our shadow demand will prove resilient unless mortgage rates spike again. And we can see the seasonality come through here. The median price of single-family homes in the U.S. is $450,000. That's unchanged from last week and unchanged from a year ago. Any shadow demand is waiting to be opportunistic. It's not driving home prices up from here, but it provides an effective floor. $450,000 over the median price last year, or median price of new listings. Yep. Price reductions show greater demand than expected too. Price cuts ticked up by just 10 basis points this week to 30.3%. Inventory was late to arrive. Buyers have been opportunistic, and you can see it in all the price cuts. No jump yet like September last year. For all the okay, so yeah, he goes into that. So that's the current state of the housing market, which I like to go over every once in a while. Charlie's got the S&P 500 technology sector is once again beating everything, up over 33% so far this year. Its relative strength versus the broad market has now fully recovered from 21-22 drawdown, surging to its highest level since August 2000. In my opinion, if you look at the ratio here of the S&P 500 technology sector versus the S&P 500, we are back in bubble territory, and we're almost to the highest level back in 2000 in terms of this ratio. This is where I would be a seller. That's me. I would go buy a bunch of commodities because they are vastly underpriced in relationship to the technology sector. And that's where your risk reward, your asymmetric bet, and where the value is. I don't go chasing waterfalls. I don't go chasing high value areas. I sell those areas and I go and I chase the undervalued areas. Here's an important reminder that says if the rationale for buying treasuries is solely based on the premise that the system cannot endure substantially higher interest rates, then gold would be a far superior choice. This is the gold to U.S. Treasuries ratio. Cool old ratio here. This is the peak of interest rates back in the 1980s. You can see gold really took off. We came all the way back in that long cycle to the bottom of 2000. 2000 was the beginning of this ratio cycle, and we've been moving up. We had a nice little pullback. That pullback was a recovery phase in the real estate cycle, and now we're going to rip it. I think we're going to rip it to the upside where gold is going to outperform treasuries, and it doesn't mean that it will go straight higher. We definitely could have a little pullback here if there is a recessionary slowdown in the system, which there might be. I'm not discounting it. And then I think we're going to rip it. The timing, unknown, but I think we've got a long valuation runway ahead of us where we could drastically outperform treasuries at some point in the future. Prior to Saudi's new 1 million barrel per day cut, global inventories were already set to hit a 6+ year low by year end. Even with U.S. European recession, now Q3 stock draws alone should be equal to about 10% of total OECD inventories. The chasm between the financial physical markets for oil is about to narrow meaningfully. This is his forecast. Basically, a stone dropping off of a cliff is our total global oil held in inventory. And I am interested to see what happens here. This is going to be the financial markets versus the physical markets. And what we're going to be watching is inventory draws. And it's going to, what's expected is that we're going to draw down our inventories, which means prices are going to go higher. Coming down, we've got Grady here. Think that it's quite likely to play out, unfortunately. Rough times coming during that U.S. bonds drop, probably. Fed would probably try to save the bond market before USD, but the global leveraged debt mountain could take down bonds anyway. So what we've got here is perhaps if there's a slowdown in the market, people are going to run to the U.S. Bond market. The bond prices could go up a little bit, creating a shoulder, head, shoulder, and then we get a massive downward move. Conversely, interest rates move opposite of that, so they're going to get pulled down to the breakout level. And I talk about this a lot on the daily update. We hit this resistance support level, and then we rip it to the upside. Maybe that takes 6 months, maybe it takes a year, maybe it takes 2 years. I don't know. No one knows. And it's not baked in the cake that this is going to be the eventual path. Right now, we're seeing some strength where we could break to the upside, especially on the long end of the curve. So again, I'm not trying to make any predictions here, but this is one potential play out that I also see in the markets that Grady is highlighting. Something to watch. And that's what I've got for today, guys. So that's in the markets. That's the information that I thought was worthwhile sharing. And really, that's where I'm going to end it. So give me a thumb up for the content, guys. Subscribe to the channel or the website if you'd like. And we'll catch you next time. This is Finding Value.